What's going on, my friends? Welcome to the Money Peach Podcast, episode 151. Today's show is going to be all about 12 days from now. So we're talking about the election. So we're in an election year. We're 12 days from November 3rd, where we are going to decide who the next president is. And if you're like me, there's a lot of people out there maybe worried, maybe wondering, maybe deciding what is going to be the best decision for me and my future when it comes to investing. You see, we have an election coming up, and a lot of us are a little uncertain on what's going to happen with my 401k or my Roth IRA, or what's going to happen to the markets. Should I be doing something differently during this election year? And yes, this election year feels a lot different than some of the ones we've had in the past. So I think it deserves the talk. So before we go any further, let me just say this, that during this episode, I'm not going to be giving you any financial investment advice. I'm not going to be telling you which investments to be putting money into or out. I'm not a licensed financial advisor. And with that said, what we're going to be doing in this episode is we're going to take a look at some of the history that has happened in the past of what we've done in election years, what it's turned out to be. At the end of this episode, you'll have an idea of how to make the best decision when it comes to your investment strategy and your money. I think you're going to understand what this means when this is at the end here, but I just have to make this disclaimer. I'm not a licensed financial advisor. Therefore, I'm not giving you any kind of financial advice. If it comes off that way, I'm not trying to give you financial advice. I just want to show you based on what we've done in the past with markets during election years, so you can make your best judgment there. So with that said, let's go ahead and move on. So the number one thing I think people are afraid of, and actually there was a poll. So 700 investors were surveyed, and 72% of them came back and said their biggest worry isn't whether it's President Trump or Vice President Biden taking over office in January. The biggest concern is the uncertainty. 72% of people are actually more fearful of not knowing who the president is on November 3rd versus who is actually going to be the president. And so uncertainty usually causes a lot of volatility in the markets. When we don't know something, when we're worried about something, that uncertainty is what causes a lot of times markets to move. And we've seen this before. This is not new. So I thought to myself, okay, if we're uncertain about who's going to become the president on November 3rd for whatever reason, okay, then let's go back to a time where this has actually happened before. Yes, if you remember 20 years ago in 2000, this was Al Gore and George Bush. And we know George Bush was the president, but do you remember that after election day on November 7th that year, we spent 36 days in limbo wondering who the next president was going to be. And in those 36 days, there was some shifting in the markets. In fact, stocks tanked in the month of November. They went down 8.1%. And the NASDAQ, which is usually your tech stocks, your internet type stocks, it dove 24% that month. Okay, so it dove down a lot. Now, this was a razor-thin election. If you remember, it came down to the state of Florida, and it actually came down to 537 votes. And what we found out is George Bush won. Al Gore contested it. In December, Al Gore said, okay, I'm fine. George Bush, you can be president. So there was a lot of uncertainty there. We didn't know for 36 days who the president of the United States was going to be. And the president was taking over in a month. We still didn't know who it was going to be. And we saw what the markets did then. Now, here's the crazy thing. Let's back up a little bit. So do you remember what happened in March 2020? Or I'm sorry, March 2000? Okay, so 20 years ago in March, it was the dot-com bubble. It burst. The dot-com bubble burst. If you remember, there was a company called pets.com that everybody thought was going to be the next big thing. It started trading when it went public at $14 a share, and it ended up trading at 22 cents a share, went bankrupt, collapsed, and it's history. Now, a lot of those dot-com tech companies were in the NASDAQ. And the NASDAQ tanked also. In fact, the NASDAQ didn't come back to where it was prior to the dot-com bubble until 2015. It took 15 years. So think about that 15-year period. How many presidents do we have? We had George Bush, we had George Bush again, then we had Obama, and then we had Obama again. So it wasn't an election month. It wasn't an election season. There was 15 years for that to come back. It was long-term. So looking back at what happened in November 2000, when we didn't know who the president was going to be, we were uncertain for 36 days. It came down to 537 votes. Really, we can think about this. Was it the election, that 36 days, that caused the drop in November? Or was that just a little blip when looking at the whole entire year, which I'm going to be getting to this year? But looking back 20 years ago, the whole entire year of the dot-com bubble burst in March 2000. So volatility will almost always happen in an election year. In fact, if you go back and you look at election years in the past, there's always volatility right before an election and right after an election. Okay. So that's going to happen. We can expect stock markets to go up or the markets to go up and down in any given election year, but it's really hard to time that. So investing with uncertainty, here's what I'm going to be doing. This is my advice for myself. Okay. If the election is contested, I'm going to still invest as I normally do. Just like I did in October, just like I did in July, just like I did in March, and like I'm going to do in February. I'm not changing anything. Why? Because history has shown us that during election years, the markets go up and down, but overall, it's a little blip in long-term investing, especially when there's uncertainty and some volatility. So another question I get is, Chris, should I wait until after the election to invest? Which is a great question. Meaning you have some money you want to put in the market, but maybe you're thinking, maybe I'll wait until after the election, after I find out the results to invest. It sounds like a good idea, right? It sounds like a good idea because right now we're kind of uncertain. We don't know where to put our money, right? We don't know when to put our money in. So maybe just doing nothing, maybe that sounds like the best option. So what I did is I said, let's go back into history and see how that would have played out for us going back maybe 90 to 100 years. So let's take a look at this. So Capital Group, if you're invested in American funds, you are invested in Capital Group, okay? So Capital Group actually went back 22 election cycles. And so they did 3 different scenarios. Scenario number 1 is during an election year, if you were going to say invest $15,000 that year, you invested it all in January, all in the very beginning of that election year, okay? Option number 2 or scenario number 2 was you didn't invest everything all up front, but you did kind of what we do with our 401ks. Every 2 weeks, every month, we did it for the 10, 11 months leading up to the election. And then option or scenario number 3 is we waited till after the election, okay? Meaning, should I wait until after the election? So what they found over the past 22 election cycles, 73% of the time, or 16 out of 22 election cycles, the first 2 options outperformed waiting till after the election. So whether you put money all in January or you did it out through the course of the year, you came out ahead financially instead of waiting till after the election. Now, I can't tell you what's going to happen in this election, but what I can tell you is in the past, 73% of the time, if you would have just invested like you normally would and didn't try to time the market, you would have came out ahead. Okay. So based on that, I'm not making any changes. Based on that right there, I'm not going to make any changes and wait until after the election to invest. I'm just going to continue to invest. I'm giving myself advice here. Wink, wink. I'm giving myself advice because I'm not a licensed financial advisor, like I said this earlier, but I'm going to this is the advice I'm taking based on the history of what's happened in the past. All right. I get a lot of questions on, Chris, what about changing investment strategy based on the presidential election predictions? So now we're seeing all these polls come out. The polls are saying Biden's way ahead. Some polls are saying that Trump's coming closer. Some people are saying polls are inaccurate. So we really don't know what we're predicting off of. We saw in 2016, like 95% of the polls were wrong. So should we be basing our investment strategy on the predictions we're seeing? For me, I'm going to say no for 2 reasons. One, again, going back in history, I'm not going to change my investment strategy based on an election year. And 2 is from my personal experience over the past 4 to 8 years, elections and polls, they're not really that accurate. I think the weatherman is about 10 times more accurate than the pollsters out there. Hey guys, I want to take a quick break and ask you, where do you get your investment advice from? If you're like most, just the idea of talking about charts and numbers, return on investments, and all these other investment terms makes you sick to your stomach, right? Look, I get it, and that's why I'm a member of the Motley Fool Stock Advisor program. The Motley Fool is an investment advice site that has a very impressive track record. In fact, since 2002, the stock advisor recommendations have outperformed the S&P 500 by over 400%. The stock advisor is just $99 for the first year, which includes 2 new stock picks each month and valuable training to make you a better investor. So why don't you join me and the other 700,000 Motley Fool members to becoming a better investor by heading on over to moneypeach.com/fool. That's moneypeach.com/fool. Okay, here's a good one. So, Chris, if it's a Democratic president, or if it's a Republican president, if Trump gets in, or if Biden gets in, or if the House goes from mostly Democratic control to Republican House, or if the Senate goes from Republican Senate to a Democratic Senate, should I take my cash out of the market? What decisions should I make? So for those of you listening, I'm going to be putting this graph in the show notes, moneypeach.com/session151. But for those of you watching right now, take a look at this right here that I'm going to put up. Let's see here. Okay, so as you can see, this is a graph of the S&P 500 going back to 1926. And what the graph shows, if blue means there's a Democratic president in office, and red means there was a Republican president in office. And as you can see, in both the blue and red years, both the blue and red presidencies, the markets went up, the markets went down, but overall, the markets went up. So really, it's you look at this and you can visualize saying it doesn't really matter, during the long term, which president is. I know that when we watch the news, we'll see in campaigns, President Trump right now is really campaigning on when he was in office, the market went up. So he gets a lot of credit for that. I think all presidents, when they're campaigning, if they had a great 4 years of the economy, they're going to use that. But really, the presidents aren't completely the ones driving the economy, right? There's still people like us that are out there working. There's still companies out there generating profits. And when companies generate profits, people, investors, like to invest in companies that are doing well, regardless of who the president is. So I think presidents probably get a little too much credit for the economy, for the returns in the market. I think really it is the people like you and I. It's the people who are running businesses. It's the people out there who are creating jobs, creating profits. Presidents might have something to do with it, small part of it, but not the overall part of it. So I think presidents give themselves a little too much credit when it comes to talking about the markets. And again, if you're running for president and the markets did really good while you were in office, of course you're going to use that in your campaign, right? Everybody understands that. Okay. So then I go back to, but I still want a little bit more. So what do the greatest investors of all time say? Okay. What do the greatest investors of all time say about investing during election year? Trying to time the market to maybe wait until after the election, or putting more money in before the election, or when there's uncertainty, changing your investment strategy. So what I did is I took the advice of, I've heard this advice over and over again, Chris, if you want to be rich people, find out what rich people are doing and continue to do that. So I thought, okay, let's start off with Peter Lynch. So Peter Lynch has a net worth of $450 million. I would call him rich. Okay. So Peter Lynch also, he was the fund manager for probably the most well-known fund in the history of the mutual funds, the Magellan Fund over at Fidelity. And so he's famously quoted for saying, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So what did he say here? Far more people like you and I have lost money trying to time the market than the market actually going down itself. So if we just follow the path of the market and we don't try to time it, Peter Lynch, who's worth $450 million, says that is a better strategy. But maybe you're somebody thinking, well, he's only worth $450 million. I really would like to hear from a billionaire. Great. So Charlie Munger, he is the partner to the famous Warren Buffett, which we're going to get to in a second. He's worth $1.6 billion. And he has a quote that says, it's in the nature of the stock markets to go way down from time to time. There's no system to avoid bad markets. You can't do it unless you try to time the market, which is a seriously dumb thing to do. That is a quote from Charlie Munger, worth $1.6 billion. He's an investor professionally. That's what he does. He invests. Let's follow rich people here. All right, $1.6 billion. But Chris, there's still people that are worth more than that. All right, you're right. Let's talk to our friend Warren Buffett here. Warren Buffett says, if we think a business is attractive, it would be very foolish for us not to take action on that because we thought something about what the market was going to do. If you're right about the business, you'll end up being just fine. That's Warren Buffett's quote, and Warren Buffett's worth $81 billion. So the theme here is when we ask very, very wealthy people what they do, they don't time the markets. They're in it for the long run. And what we've seen in history is when you try to time the markets, including an election year, 73% of the time, you're wrong. And if you don't believe me, let me give you some personal examples here. Okay, 2 personal examples. So we're going back to 2016. President Trump beats Hillary Clinton, November 2016. I have a good friend who hates President Trump with a passion, okay? And he let his emotions get involved, and he was convinced that because President Trump or because Republicans were going to be in office, that the stock market and the economy would be trashed forever. So he had a pretty good sized 401k, and he took all of his money out of the 401k. He works in Phoenix, and he put it inside what's called a Phoenix Stable Income Fund. It's basically a money market account, a very, very safe investment. And he's averaged, we'll get to that in a minute, but it's a very safe investment. It's what you would do if you wanted to just kind of protect your money. The money's not going to go up and down, but it's not even going to keep up with inflation. So that was in 2016. And He's never got back into the market. He never went back to investing. He timed the market. He thought the markets were going to tank. And then after that, he was going to invest and be ahead. Well, what happened is if you look at the S&P 500 and you go back to November 8th, 2016, and you were to look at the return from November 8th, 2016, all the way up until today, my friend missed out on 60% returns. He got 1.5% return on his money market account. But it was a 60% return since then. He tried to time the market. It doesn't matter which president he likes, or which president he hates, or who he's voting for, or which he got his emotion involved. He tried to time the market and he lost big. I have another friend, or friends, I should say, a group of friends, and some of you might even be watching or listening to this right now. You know who you are. A lot of them pulled out of the market on March 16th, 2020. What happened on March 16th, 2020? Coronavirus. That's when the shutdown started happening. Panic, fear. What happened? We didn't know what was going to happen. So it was volatility, lots and lots of volatility. And we had a huge decrease in the market. And there was panic. And what did people do? People jumped out. They pulled all their money out of the market. They went into cash and they were like, we're going to time this out for the year. Well, if you look at March 2020 and you fast forward all the way to today, there's been a 54% return since March 23rd. In fact, if you go back to February, the last day of February, the markets are almost exactly where they at. We're actually ahead in where we were in February of this year. And we're right on pace. We're almost right there neck and neck with where we were a year ago. So what happened was so many people tried to time the market. My friends tried to time the market. They pulled all their money out. They pulled out as it went down. And now the markets are back up and they didn't get to enjoy any of that growth. Now, some people out there might have some timed it where they pulled out and at the rock bottom, they got back in and they timed the market perfectly. That's going to happen from time to time, but it's not the norm. Like I said, 73% of the time when you try to time the market during election season, you fail. Hey guys, I wanted to take a quick break and ask you this. Are you currently banking at one of those big national banks? Keep in mind that those big national banks, they have customers and their customers are there to help them earn a profit so they can keep their investors happy. Local credit unions, on the other hand, are nonprofit. They are owned by members, and guess what? They focus on keeping those same members happy. Plus, smaller local banks and credit unions, they focus their attention on the local community and they keep the local funds inside the community instead of sending money out of state like the big national banks do. Look, if you can't tell, I'm a huge fan of local banks and credit unions. And if you live in the state of Arizona, I invite you to join me at my own credit union, 1AZ Credit Union. You can learn more about and become a member at 1AZ Credit Union by going to 1azcu.com. That's 1azcu.com. So with that said, my last takeaway is this. My last takeaway is I want you to think about this. If you go back over 98 years and you look at the average return of the stock market for the last 98 years, on average, it's returned 8% every year on average. Some years were really high, some years were really low. 2008 had like a negative 37% return. But back in some, I think it was like 1945, we had a 45% return. So different years have gone up and down, but overall 8% average return. And during this time, we've had a Great Depression. We've had a World War II. We had a Korean War. We had a president who was assassinated. We had the Vietnam War. We had the Watergate scandal. We had the Black Monday of 1987. We had the Bill Clinton scandal, the dot-com bubble. We had a contested election in 2000. We had 9/11 happen, the Iraq War, and the Great Recession of 2008. Nowhere in that group did I mention that we had a weird election, maybe the contested election, but it was never this president was in office or this president was in office or it was Republican or it was Democrat. All of these things have happened, and yet the markets have still responded well over the long haul. Maybe not every year, but over the long haul. And I want you to think about this. March 2020, the markets plunged 6,400 points. That was the Dow. The Dow plunged 6,400 points. It was a negative 26% for the month of March. Did you know this was the biggest point decrease in the history of the markets ever? Not 2008, this year when it went down. And fast forward to now, and we're back to where we were in February. Back to where we were in February. So my takeaway here is don't allow election predictions and outcomes to influence your investment decisions. Don't allow election outcomes to make you want to time the market. Okay? It doesn't work out. View the volatility. If we do have uncertainty, if November 3rd comes and goes and we don't know who the president is, if November 20th comes and goes and we don't know who the president is, we can expect volatility. Absolutely. But what if we looked at volatility as a positive opportunity to buy when the market goes down instead of a negative worry? What if we could go back in time? I would like to do this as well. Go back to March and just start buying everything when the market was going down instead of getting out. We'd be ahead. So look at the volatility as a positive opportunity. And lastly, I'll leave you with this: is think long term. When we're investing, we're not investing for tomorrow. We're investing for the long term. We're not short-term day traders here on the show. We're looking at, where are we going to be in retirement? How do we get there? What's our nest egg going to look like? Think long term. All right, guys, I will have all the show notes, all the links, anything that I mentioned in this episode, including that graph you guys got to see of Republican versus Democratic presidents since 1926 to 2019. It shows you how the markets have responded. They'll be found over at moneypeach.com/session151. That's moneypeach.com/session151. Thanks very much for being here. Take care. We'll see you guys next week. Another amazing episode of the Money Peach podcast. Take care.